When you start trading, you think the more pairs equal more opportunities and you're gonna make way more money if you start trading way more pairs. You wanna trade gold, Nasdaq, and many Forex pairs at the same time to maximize profits. But the harsh reality of the trading world is more pairs equal more losses and more inconsistency as well. I've personally traded for over 3 years and I've made well over $500,000. And I've managed over 7 figures in funded capital and kept it for the longest period of time possible, which is over 500 days. And I've personally ever only traded 3 pairs, 1 pair at a time. By the end of this video, you know exactly what pairs are worth trading and worth your time, and which ones are actually gonna make you money in the long term. Why pair selection actually matters. The reason the choice of pair is very, very important is because your strategy doesn't work on every single pair. That's something you need to understand as a trader. When you collect data, you're collecting specific data for that specific pair. You can't expect a certain pattern that's mathematically and statistically profitable for the last 10 years, let's say on GBP USD, for it to perform the same way now when you trade it on Nasdaq or German 40, for example, because each pair moves differently. There's different market participation, there's different volatility, different volume every single day. Each pair is actually underlying a different market. So there's no correlation. You can't expect your strategy to be universal across all pairs. That does not work, especially when you're going mechanical. Discretionary is possible, but I advise against trading discretionary because discretionary trading is not really profitable in the long term like mechanical trading. I learned this the hard way, guys. This is all from my personal experience. I used to trade a lot of pairs and I used to jump from pair to pair. I would lose 2 trades on one pair and I would jump to a different one trying to make that back. But in reality, I end up losing then as well and I would just blow my account over and over again. The only pairs worth talking about as a beginner. Firstly, I want you to ignore all the 28 plus pairs out there on your broker, on your trading view. Ignore them. The only pairs you need to really focus on is USD pairs are the strongest. These are the majors. Euro USD, GBP USD, the yen against the USD. These pairs move usually the cleanest because they have the most volume and the tightest spreads as well. Gold is a good pair to be trading once you accumulate a little bit more trading experience because gold is way more volatile and it moves a bit more erratically in comparison to some other pairs like GBP USD, which would have a very clean move around London Stock Exchange Open, or the Nasdaq will have a very clean move and clean structure price action around New York Exchange Open. But gold will move erratically throughout the day. It can have a massive spike on a random time of the day, maybe because there is a geopolitical event that's going on, a new announcement from the Fed, or Trump tweets something, the current president tweets something. So you gotta be really careful with gold. And those are not really required for you to know, and I would suggest not trading them because the spreads are gonna be way wider and you're gonna have way less volume, more volatile, and way less predictable in the long term. Your data is gonna be inconsistent because they're already very low volume. So now if you're testing and collecting data for decades on that pair, it's not really ideal. Now I want to talk about the pairs that I actually trade from my own personal experience. For the longest time, my main instrument has been NAS 100. You might be asking, it doesn't have USD in it. Again, NAS 100 is an index. It's an indice. What that means is NAS 100 is actually tracking the overall price of the top performing stocks in the US, which inherently is USD because the US uses USD. The reason I love trading Nasdaq is because Nasdaq is not that volatile. It has a lot of volume, it moves very smoothly, and especially around the New York Exchange Open, it makes really clean price action. And I will show you later in the video on the chart how Nasdaq actually makes really clean structure around the New York Open time, and then it continues to follow similar clean patterns throughout the day, which makes it way more predictable and way more susceptible to my breakout strategies. The second pair I love trading in my experience is GBP USD. I might be a bit biased towards GBP USD because I live in London. Fun fact, the HSBC building is right behind me right there. But in London, especially if I'm on a good routine, I'm waking up early in the morning, GBP USD is the best pair to trade because around 8 a.m. London time is when the London Stock Exchange opens. It gives you a really good opportunity in trading the London session. If you want to maybe have a strategy for the London session, GBP USD will be the best because you can get 1 or 2 trades done before New York session opens, and then in New York you can now go to NAS 100 and try to get your main bigger move of the day. And that's how I would kind of structure my day if I'm trading 2 pairs, even though I would suggest for every beginner to pick 1 session, 1 pair, 1 time frame. So I would say probably pick New York session and trade NAS 100. The third pair that I've traded in my experience And I love trading it, but it's the highest risk. That's why I don't recommend any beginner to trade this pair, and that is gold. Gold can be really, really profitable once you have gained a lot of market experience, and especially once you have put in a lot of chart hours on gold in specific. Because the reason for that is it's high risk, but also high reward. It moves so aggressively. If you catch the right entry and you can get the right exit, you could be catching a massive position that would be like a swing position on GBPUSD or on Nasdaq. So I would recommend to stay away from gold, but definitely add it to your list that you want to be learning and improving for the future. To be honest, as a beginner, gold will punish you before rewarding you. The overall rule of thumb with pairs is the less a pair is traded, the more randomly it behaves. And randomness kills mechanical systems. So you really need to dial in with your popular pairs like EURUSD, GBPUSD, Nasdaq 100, S&P 500. These are the pairs you need to focus on. Don't focus on these exotic pairs because those are very random and we don't want randomness. There is 3 ways that you can actually determine if a pair is actually worth trading. The number one thing is you look at the spreads. Are the spreads tight? If the spreads are really tight, you can see that on your broker website or broker dashboard or even in your MT4, MT5 terminal. If the spreads are very tight, that pair is most likely very well traded and is a good selection. The second thing to look out for is, does that pair move specifically well during a certain session? So GBPUSD during London, EURUSD would be also around London. Then you would have gold and the Nasdaq of the New York Stock Exchange Open, which is around 2:30 p.m. London time. If those pairs move really well around specific times, they're really good for us because you can now start predicting certain behaviors around specific times. But if now the pair is moving erratically throughout the whole day, there's not much to predict. Because when are you going to trade? You're going to trade 2 p.m., 2 a.m., 1 p.m., 7 p.m. You don't know when to trade then, right? We want consistency in trading. And the final thing to look out for is you can specifically pull up the chart for whichever pair you want to trade and just look for higher highs, lower lows, lower highs, higher lows. Look for clean price action. You want smooth price action all across the board. What you don't want is you don't want consolidation with a massive spike up, consolidation, massive spike down, consolidation. Something around crazy consolidation and a lot of wicks is something that we don't want. We want strong body closes on the candles, not wicks. Wicks are risky. Wicks mean there was a lot of volatility and people have basically been liquidated. That's not what we want. Okay guys, so now I'm going to show you exactly in the charts what I mean by the different pairs and how they move and how you can actually capitalize on the key movements for certain sessions for these pairs. So as you can see on my chart right now, we have gold. One of the things you might realize here is gold, it's all over the place. First of all, this is a massive consolidation period. And consolidation is not good for mechanical trading strategies because what will end up happening is we'll have a ping pong situation where you'll be entering longs, you'll be entering shorts, entering longs, or you'll be entering longs on the downway, but you'll just end up getting stopped out. And that's something that we don't want, guys. We want clear breakouts for mechanical strategies. And a clear breakout will be something like this. Look at this. This right here is a clear breakout. I was to show you, for example, here, this is not a clear breakout. For example, enter a long here and then price goes down into a short. You enter a short here and now you go back up. That's ping-ponging between your losses. Stop loss ping-ponging is not what we want. And gold specifically doesn't follow a specific timing. Timing is very important when it comes to trading. As you can see right here, gold doesn't really follow specific timing. It's moving insanely fast all across the board, no matter what time it is. There are certain times when it moves extremely fast, and something that you have to make sure is gold is extremely aggressive. For example, right here, you're in a short position and your stop loss is here. You best believe your stop loss is not getting triggered around here. You're most likely gonna get triggered here. So you're losing way more than what you expected to lose. So you gotta be really careful with that as well. If I show you GBPUSD, now we're talking about more stable pairs. So my chart currently is calibrated to London time. It's 8 a.m. London time. On this specific day, not much has happened. So this is not the best example, but even though you can see we had a fairly clear bearish run from there, followed by a bullish run. If I go on a previous day and try to look for London Open, right here, this is a fairly decent one. Look at this. If we were to trade a breakout around London, you would get a clear downward move without those crazy moves like going everywhere that would stop you out, because that's what we don't want, guys. If I go to another day as well, just to show you, this day, I guess you got some movement, still way smoother and cleaner than gold was. Like you get a massive pump here, which is something that we can capitalize on. On a previous day, again, this is beautiful as you can see. London Open, nice move up. That's basically what we're looking for when trading, guys. Something that we hate is this kind of stuff. This is what we hate. This is something that we don't want. But again, as you can see, this was around 10 p.m. London time. So this is Asia session nearly now. So we are good. Now on the same day, if we go back to 8 a.m., which is London Open, look at that. Beautiful move to the upside. So gold gives you this kind of stuff all across the board, but GPUSD around London will give you these kind of moves. And that's what we want. I'm gonna quickly show you NASDAQ, because NASDAQ follows the same principle, but around 2:30 p.m. London time. Around here, as you can see, 2:30 p.m. London time, NASDAQ clean, smooth move like GPUSD was doing around London time. And that's exactly what we want, guys. And I can show you another example somewhere here, previous day. Again, around open, you had a clean move to the upside. And that's what we want. We want to catch these nice moves, guys, during the actual session. We just don't want to be entering a trade and exit it right away and trying to enter again to catch a trend when there might be no trend. That's why trading these stable pairs is way better. You can catch way better trends. And I can show you this even another day before. So like around right here, look at this. This is beautiful from here straight up. Yeah, this is the overall concept. As you can see, this is what we want, guys. So the conclusion to this video, guys, you don't need 10 pairs. You just need one or two that you understand completely and you can stick with it, backtest, collect data, understand how the pair moves, learn the ins and outs of that pair, and then go ahead and start trading that pair and start mastering how price action actually moves on that specific pair. I built a 7-figure trading account, guys, with prop firms, and my personal trading account is 6 figures, and that's all using the same concepts and the same mindset and knowledge that I'm sharing with you today. I've told you about multiple pairs today, but keep in mind, move on to the next pair only when you master one. Don't try to master all of them at the same time, because that won't work. That's like starting 3 businesses at the same time. It's best to put all your focus on one single business, grow that business really well, and then branch out to different businesses.